Harvard Business Review presents Maximizing Your Global Opportunities. And now I'd like to turn today's Harvard Business Review webinar over to your host, Angela Herron, who is the editor for Special Projects and Research at Harvard Business Review. She joins us today from her offices just outside of Boston. Angela, welcome to the program, and the audience is all yours.
Thank you, Jack, and thank all of you for joining us today. And I want to thank UPS for making this discussion possible. Despite lingering uncertainty about a recovery in the global economy, it's clear that organizations are all searching for new revenues and an understanding of how to navigate both the challenges and the opportunities out there. There are, of course, encouraging signs. Market indexes are up, international trade has been rebounding, and commodity prices are up across the board. Global trade in capital goods has boomed. So all this points to the need to focus on the opportunities available if you want to optimize your global supply chain. So how should companies, from small and mid-sized to large corporations, think strategically about the global economic picture? How can they best identify the right opportunities and their own potential competitive advantage when the recovery is not equally strong in all regions? Here to talk with us today about these issues is Jeff Rosensweig. He's an associate professor of international business at the Goizeta Business School at Emory University. He's also director of the Global Perspectives program at Emory. Jeff specializes in global strategy, global economics, and international finance. Prior to joining Emory, he was senior international economist at the Federal Reserve Bank of Atlanta. Jeff has also taught at MIT and the Economics Department and the School of Management at Yale University. He's the author of 2 books, Age Smart and Winning the Global Game. Jeff, thanks for joining us today.
My pleasure. It's a great time to be discussing this subject.
Jeff, I'll wind the clock back a little bit and ask you, how did you come to focus on the whole area of global economics?
Interestingly, I studied economics as an undergraduate, but then I won a Marshall Scholarship to Oxford. A Marshall Scholarship is one given by the British government. Some other winners are more famous than I am, such as Reid Hoffman, who, as you know, just started LinkedIn, Ray Dolby of Dolby Sound Systems, and also Thomas Friedman, the author of World is Flat, where he discussed, amongst other globalizing forces of logistics, not just the World Wide Web, but companies, for instance, that help with global transportation, the globalization of education, which, by the way, we're seeing right now. About 1/3 of the people on with us are coming from outside of the United States. So I had a great chance to travel to other economies during the years that I had this scholarship, and that turned me on to the global economy and such things as exchange rates, which we'll discuss later. But also I had a great chance to visit a number of what at the time were in some sense underdeveloped markets and are now very much emerging markets that present great opportunity, and we'll discuss that throughout the next hour.
Well, Jeff, as I mentioned in my introduction, it is an uncertain picture. Can you help us sort of build a framework for how we ought to be thinking about the global economy and where to look for opportunities?
Yes. Right now, everyone focuses on certain worries. Let's say Greece dominates the headlines, but actually Greece is a very small economy. I think that people listening who are either in business or also perhaps thinking about their own investments or they are investment managers need to focus. There are over 200 economies on Earth, but most of those are very small. Now what I want to point out is that if we look at, for instance, the top 20, we encompass the vast majority of economic activity, financial wealth, all of that. So I'm not at all minimizing the problem that a place like Greece or Portugal can cause to the global financial system, although really only in the short run. But I would like to focus people on the global opportunities that will lay ahead for them in their careers and also for growth of their companies. And that's why if I look at the first slide that actually has some graphs after we get through the preliminaries, we see a graph, and it has a bunch of blue solid bars, and then it has some striped bars, and I will be discussing the difference. But what this is out of the over 200 countries for which we can get data, I've selected the 20 largest economies, again, because those 20 dominate any economic or wealth magnitude. And I've listed them in descending order, with the largest being on the left, the U.S., and then China, as many listeners know, has just passed Japan to become the second largest economy. And then we list all top 20. There's a few things I want to highlight, and then we'll move on. First thing to highlight is that the U.S. is still by far the largest economy on Earth. We hear so much about China, and I think a lot of people don't understand that what China has been leading on is economic growth. But, sometimes you can grow fast from a lower level. In a level sense, the total size of an economy, the U.S. Is by far the largest, has been, and will be for quite a number of years. There is a lot of talk that China one day will be the largest economy, and it will be if it keeps growing much faster than the U.S. But it also is very important to remember that China has 1 billion more people than the U.S. The U.S. has 300 million. China has 1,300,000,000. So in a per capita sense, the U.S. will be much larger, as will some of these countries that we see some solid bars. For instance, we see the second check, the middle green check over Australia. For a country with a population just over 20 million, Australia, as we can see, is one of the world's major economies. Very, very impressive. So I just want to point out two or three things. One is the striped bars are nations that are what we now call emerging markets or developing nations. Again, they used to be poor, but now they're coming on very rapidly, and they're great sources of opportunity. We see the biggest is, as we discussed, China, but also Brazil is now a major economy on the world scale, as is India and Russia. I put a red X over Indonesia because that's one people are starting to speak about as a wonderful place for business opportunity. It's the fourth largest population on Earth with a 250 million people with a lot of natural resources. So to summarize, for almost the last decade, when people talk about the emerging markets, they focused on the BRICS, Brazil, Russia, India, China, and we can see they are the four biggest. But on the other hand, many people talk about all the risks in Russia, the geopolitical risks, and there's an increasing interest in Indonesia. So it's more like the Bicky. I also want to highlight that Mexico is a very large economy. For those of us in the U.S., because they're tied to us through NAFTA, North American Free Trade, they're the second biggest market for us for our exports. So we also don't want to miss Mexico and the rise of Turkey, for instance, and the rise of Poland. So that is my main theme here, is that there are huge advanced nations, U.S., Japan, advanced economies. You see a number of European ones. You see how wonderfully Australia has positioned itself. But we also see these large emerging markets. Now, the way this slide was constructed, I'm now going to contrast it to the next slide. The way this slide with the blue was constructed was we took every nation's GDP, its total production, which is a measure of its national income, which comes in its own currency terms, whether they're yuan or euro, etc. And then we converted them to a common standard, to the U.S. dollar, so we can compare. And we used the exchange rate in the market. The market exchange rate is what you would see on your computer screen or get at the bank. But the next slide is a similar one, but it presents the comparison in a slightly different way. It says, what are the 20 largest economies on Earth? In order to compare them, we can't compare a nation's income in rubles or in Turkish lira to another nation which uses the dollar, because maybe it takes a lot of lira to get a dollar. Maybe it's easy to be a millionaire when you earn lira in Turkey. So now we're going to convert again, use an exchange rate to convert to a common standard, and we'll use the U.S. dollar for a common standard. So the U.S. is still about a $15 trillion a year economy. But when we convert to a common standard, we're going to use something called the PPP, the Purchasing Power Parity Exchange Rate. Parity meaning equality. So it's a hypothetical exchange rate. It's not one you can get at the airport when you change your money or get at the bank. It's a hypothetical exchange rate which gives equality between what the purchasing power of your money is if you spend your money, for instance, in the U.S. or if you go to China. Because in China, things will seem very cheap, seem very inexpensive if you have U.S. dollars. There's a feeling that their currency, the yuan, is undervalued, that you can get a lot of yuan for a U.S. dollar, and you can buy a lot. On the other hand, if you go to Norway from the United States, Norway, probably because they have so much North Sea oil, their currency has become very costly, very overvalued, and it's very expensive to go to Norway. So we wouldn't have too much purchasing power in Norway. So anyway, this attempts to correct for that. It's something that businesses use all over the world. For instance, if someone who was listening was given a 2-year transfer to another country, there'd be cost of living adjustments using this. Anyway, if we make this adjustment, what we see is a country like China, whose market exchange rate put a low value on their dollar, so they didn't look like they were generating that much dollar income on the graph before with the blue bars. Suddenly China, when you correct for their actual purchasing power, that they're doing a lot in China, it just doesn't have much dollar value at the market exchange rate. Suddenly China is a very large economy. It's by far the second largest economy. It is catching up to the U.S. We also see that India is now the 4th largest economy on earth if we make this adjustment, and it is a hypothetical adjustment. And in fact, because India's economy is growing much faster than Japan's, India will soon become the 3rd largest economy on earth. We also see that Russia and Brazil are quite large, larger than some of the big European economies. So once again, we see the BRICS are very large. But again, I put a check over Indonesia to show that Indonesia, again, it's the new exciting place for a lot of businesses that are looking for global opportunity. It's quite a large economy, but so is Mexico. If we see Mexico in the center of the graph, and South Korea, Turkey again. Interestingly, not on this graph yet because it's coming off of a low base, but Vietnam is another country. As I travel around and talk to CEOs and other top executives, they're very excited about Vietnam. It is a country with rapid growth rates, becoming one of the world's larger economies. I would predict in 10 years, Vietnam would be well positioned within this graph of the 20 largest economies. But the takeaway again is all of a sudden, amongst the world's largest economies, many of them are these emerging markets. As we look for global opportunity, we have to remember that the U.S. is by far the largest economy. Japan is a major economy. A number of European ones are. We don't want to forget that that's where there's a lot of money, but also there's a lot of opportunity in the big emerging markets. Now, what we'll do is we'll move from talking about who are the big economies, we'll talk about where is the economic growth, and we'll focus on something that I'm sure a lot of listeners are wondering about, which is, are we really in an economic recovery? It was clear with the financial crisis, for instance, when Lehman went under in 2008, that the world was in a recession in 2008, and most of the countries, such as the U.S., continued in recession. In other words, a declining economy, one receding, like a hairline could recede, one going backwards, the first half of 2009. Now, interestingly, we call that the Great Recession, and we can discuss that later, because it was much deeper than other recessions, other declines. In some measures, it was the worst decline since the Great Depression of the 1920s. Certainly in terms of the job market and the loss of jobs, it was the worst since the 1920s. Interestingly, we have been in an economic recovery, meaning a return to growth in the U.S., but really the rest of the world, since exactly 2 years ago, since June of 2009. However, because the recovery has not been very fast in many places, and it has not been fast in the U.S., it has not been a strong recovery, a lot of people are still doubtful whether or not we actually are in a recovery, or are we just muddling along the bottom still. Furthermore, a question that we were asking ourselves, let's say a year ago, when the economy had lost some of its momentum, was, are we at risk of falling into a double-dip recession? Assuming we did have a recession up till June of 2009, then it looked like we were growing again. Would we fall back down? Now, what's interesting but a little troubling is that's the question people are asking themselves right now. It's something that may come up in our question session later, is, are we at a major risk of falling back into a double-dip recession? Fortunately, last week we saw the stock market rebound a little bit, but we'd had those 6 straight weeks of decline in the stock market. We've had some troubling economic reports, which have shown a loss of momentum. So there is a worry of a double-dip recession. But what I'm showing here is the very latest forecasts by a consensus of excellent forecasters for the largest economies in the world. Again, we're not going to focus on very small economies because these economies I'm showing are over 90% of world action. And what we see is, with the, I don't know what color it is, kind of a somewhere between pink and purple bar, 2011 forecast, and then in the blue, the forecast for 2012. And every single large economy is forecast to have their economy grow both this year and next year. In other words, as we see in the title, we are in a forecast by really all the major forecasters of continued economic recovery. The problem is, if we look where the check is for the U.S. at the green check, the forecast is will grow about 2.5% a year. That's better than having a double-dip recession and falling back, but we need to grow that fast just to maintain our unemployment rate. We need to generate growth in order to hire the new entrants into the labor force. Our labor force is still growing. We have a lot of people coming out of high school and college, as I'll show later. And also, in order to compete in the world, we have productivity increase. Productivity is output per person. So you have to grow your output just to maintain your employment. So a long-term growth of the U.S. economy has to be about 2.7% a year, which is what we're achieving this year. So a lot of people right now are drawing the comparison between this recovery and, for instance, the recovery in the 1980s from a deep recession in the early 80s, the recovery under Ronald Reagan, where the economy grew more like 5% a year, and they're saying this is inadequate. This won't do anything about our 9% unemployment rate. We need to do something to spur the economy. The final thing I want to say about this graph is we once again see that I striped some of the economies, and to be consistent, those are the emerging markets, the nations that were poor but have been developing. the BRICS, or as I say, the BICI if we include Indonesia. There's now a lot of growth in Africa. For instance, we see Nigeria growing very well. South Africa is growing, and there's many other nations in Africa, such as Ghana and Angola, which are also growing and becoming economic success stories. But interestingly, taking these large economies, which also have large populations in general, such as Nigeria and Indonesia, I rank them from the bottom of the graph up according to their growth forecast for 2011. And what we see is all these emerging markets are forecast to have faster growth than all the advanced economies, the ones with solid bars. Now, this doesn't have to happen every year, and it doesn't happen every year, but I think in line with today's subject, which is global opportunities, it does add some real meat to the idea that emerging markets truly are emerging, that there's a lot of wealth being generated. We saw before that some already are huge economies, and they are growing rapidly. Not surprisingly, we see China forecast to continue as the fastest growing economy, and India as the second fastest. And between them, they comprise over 2.5 billion people. And if you have 2.5 billion people growing the economy 8 or 9% a year, in fact, it will change the face of business throughout this century. Okay, now what we'll do is we'll turn to how does this economic growth, some of these global opportunities, both in the big advanced nations, such as Canada, Australia, European ones, and in very prosperous emerging markets, such as Brazil, large ones, and China, but also the truly emerging ones that people are excited about, such as Vietnam and Thailand. How does this impact the U.S. economy, and how important has it been for the U.S. economy? If we can show that there are already trends where global opportunity is being generated and is a locomotive for the U.S. economy, that can give us more confidence that these forecasts that we just saw, that there will be very strong growth in most of the world, particularly the big emerging markets. Perhaps that can be a locomotive to keep the U.S. out of a double-dip recession, to help the U.S. continue in its economic recovery, and even we can hope to accelerate our economic recovery at some point and really put a large dent in our unemployment problem. This graph looks at U.S. international trade, both what we buy from other nations, our imports, and then our exports, our sales. And if our sales are going up, our exports, that's one thing that has generated this economic recovery in the U.S. Now, everyone knows that the U.S. does have a trade deficit, that we import more than we export. And what I want to show you here is that's really due to trade in physical goods. Goods can be commodities, oil, agricultural commodities, metals, or they can be manufactured goods. For instance, the advanced countries sell a lot of manufactured goods, and increasingly China does, and a lot of factories are now being outsourced to places like Vietnam and Thailand and Indonesia. So there's a tremendous amount of trade in physical goods, and that's what dominates trade in most nations. Some nations are predominantly tourism exporters. Think about some Caribbean nations, and tourism is not a physical good, it's a service. It's the travel services, the hospitality services. So that would show up in trade and services, which we see from a U.S. context on the two lower lines, the smaller dollar amounts, the blue and the orange. Now, even for the U.S., trade and services are very substantial. These are showing us billions of dollars per month, and we see that U.S. exports of services, sales of tourism, sales of financial services, educational services, and also transportation services. Think of companies such as Delta Airlines or UPS or American Airlines, companies that are involved in transportation or could be involved in tourism. Anyway, for the first time ever, the U.S. has achieved $50 billion per month, or $600 billion at an annual rate of exports of services. So I put that red X over the services from the U.S. Exports, and we see they're hitting a record high. They had gone down a little bit when the world was in recession, so they didn't send as many tourists. But now we're at a record high, and the orange is higher than the blue, are imports of services. In other words, the U.S. has a trade surplus in services. Those of you who are listening who work for a service-based business, you can feel good about that. We are actually quite competitive in service industries, we meaning the U.S. And others of you listening, there are people listening from Brazil, for instance. You're quite competitive in goods, both manufactured goods like your airplanes, as well as commodities such as your ethanol and your iron ore, which you sell to China. Just like Australia sells a lot of manufactured goods, they sell a lot of iron ore to China so China can make steel. Both of these nations attract a lot of tourists, so they also export a lot of services. Okay, the final point I want to make is the U.S. does have a trade deficit in general because the deficit is quite large in goods. We can see the black is higher than the green lines. But notice the rapid increase in the green line, so I have a check there. What that means is U.S. exports not only of services, the orange line, but also of goods, manufactured goods, for example, are rising very rapidly. And if we see the check, we can see they've achieved a new high, a new record. So the U.S. is achieving records on exporting of all categories, and this is creating jobs in the U.S., and it truly is the locomotive of the economic recovery in the U.S. to the extent that we saw that there are forecasts of rapid growth in many countries outside of the U.S. There'll be growing markets for U.S. exports, and I believe that will keep the U.S. from falling into a double-dip recession. I think because of the problems with financial systems, for instance, the U.S. has about a 20% chance of a negative scenario where we fall into a double dip, but I don't expect it. And one reason is this boom we're seeing in exports. Interestingly, the U.S., which has lost millions of manufacturing jobs, actually has gained on net 300,000 manufacturing jobs, nearly 300 in the last couple of years, and it's because of this boom in the exports of manufactured goods. Now we have to ask ourselves, why is the U.S. able to compete so well in its exports of, for instance, manufactured goods? Why are we able to sell manufactured goods so well into Canada, into rising nations like Brazil, and into Europe, where there's a great deal of purchasing power, or Australia? And the next graph really helps us understand why in the last 2 years the U.S. has had such an export boom. We discussed before one of the two major factors. The fact is that you export into markets, and since the major economies in the world are gaining income and they're producing more, they have more purchasing power, they're creating jobs, they're able to buy more in general, and amongst other things, they buy from the U.S. So there's an income effect where nations are gaining income and their markets, and they're buying more. But there's a second effect, which is a relative price effect. Those of you who studied economics, and I'm sure most of you did, know that we always have income effects and price effects. And what we see on this graph is major currencies outside of the U.S. The Australian dollar there on the left, and the Brazilian real, the South Korean won, the Canadian dollar, the Mexican peso, the Japanese yen, for instance. These currencies have all gain value, meaning they're stronger, they can purchase more U.S. dollars since March of 2009. They were at a low value in March of 2009. People were worried about the world financial system. They wanted to park their money in the U.S. and in U.S. dollars. They thought maybe that was the safest place to be in a true perfect storm in the world financial system. But then the system held together, and as I said, we've been growing for 2 years, and the world economy has been growing nicely for 2 years. There's a lot of worry, about Greece, for instance, but things have held together. And people who were just hiding in the safe harbor of the U.S. dollar, maybe in U.S. Treasury bills, started seeing the great opportunities in Australia and Brazil. I bring those two up because look how much those nations' currencies have gained against the U.S. dollar. People started investing in those nations, and they had to buy Australian dollars or Brazilian real or Korean won, and that pushed up the value of their currencies as people were buying those currencies. What that means is if you're a tourist in Australia or a manufacturer looking to buy some capital goods for your factory or a consumer, things made in the U.S. or tourist visits to the U.S. or coming over to get your MBA at Harvard or my university at Emory University, all of a sudden we're very price competitive. So there's that relative price effect that the gains in these currencies against the U.S. dollar means that the U.S. dollar is cheap to them, and therefore the production of U.S. goods and services are cheap to them. They have a great deal of purchasing power. Just to wrap up that point, even China is slowly letting their currency gain some value against the U.S. dollar, mostly because in the U.S. we're very angry that in our mind they've been holding their currency fixed at what is to us a very cheap level, which makes their goods very cheap in U.S. markets, but our goods are very expensive in their markets. So we have a trade deficit with China that's approaching $300 billion at an annual rate. Well, understanding that we're quite upset about this, China is slowly having their currency gain value, but not very much. But finally, I put in those two yellow arrows to call attention to the euro, because even with all the discussion of the problems in the euro area, and they're truly hard problems, with Ireland and Portugal and Greece using the euro and those countries with large debt problems, we still see that the euro itself has gained 10% in value against the U.S. dollar in the last a little over 2 years, that the U.S. still produces many things which are cheap from the perspective of Europeans. We also see the UK pound has gained 15%. So they can still buy U.S. products, and it seems cheap to them, or they can come here as tourists or as students. I want people to be aware of that because, with the euro having some problems, people might think, well, they can no longer afford to buy U.S. products. Europe must be cheap to people from the U.S. The euro must have lost so much value. Actually, any U.S. person listening who has gone to Europe knows that it's still very expensive. I'll pause here while listeners are preparing their questions. Angela, do you have any questions, or shall I go on?
No, I did have a couple of questions from folks. Certainly somebody asked, when you were talking about the manufacturing jobs increasing in the U.S., are you actually seeing a trend where manufacturing is coming back to the U.S., where jobs actually had gone overseas and have come back, or is this strictly a reflection of growth in demand for exports?
Brilliant question. Most of it is a reflection of growth, that there is growth in the world. So, for instance, our production is rising 5 or 6% a year. Our production of manufacturing, not our overall GDP, and that gives us a chance to bring some factories back online, expand some factories, and hire some people. There is some insourcing, some things that we had outsourced coming back to the U.S. now that we're price competitive and that we're buying the world's best capital goods and improving our quality. But a lot of it is due to increased demand. And the main thing is it's really the fact that the U.S. can compete, that there isn't as much need to outsource when there is increased demand. We also see something interesting, which is countries or companies in the rest of the world finding the U.S. labor force well-educated, skilled in many cases, and finding us cheaper. And not just European companies, which have traditionally put some factories in the U.S., or Japanese one putting car factories here, but even companies which are developing in or growing large in developing nations, in Brazil, in China, and India, are putting factories in the U.S. One thing is we are cheap. Of course, they also want to be much closer to the market. So for a variety of reasons, we do see this comeback in U.S. manufacturing. It may interest people that manufacturing, which had been one-third of U.S. jobs, for instance, in the early 1950s, has fallen to 1/11. Only 9% of U.S. jobs are in manufacturing. And as I speak to people all over the U.S. when I travel to give lectures, they're very worried. Are we losing all our manufacturing core? Do you need some core of manufacturing? So it's very reassuring to see that that core is actually growing and prospering.
So I guess my only other question is I'm a business leader of a company of any size, and is my takeaway from these numbers that I should really be out there exploring as much opportunity in the global market as possible? What do I need to be thinking about?
Yes, two things. One is the world. The U.S. is by far the world's largest economy. It faces risks, but it will grow in the future. So one should not panic and, for instance, pull completely out of the U.S. and close everything down and go running off, for instance, to China. The U.S. should be the part of anyone's strategy, whether they're a business manager or an investor. But still, within that, there is the sense that the opportunities for growth, most of the opportunities will be overseas. And what I'm trying to develop here is that we do live in an uncertain world, and managers listening need to take a very diversified approach to that. They should still ask themselves that, as with the U.S., where are places that have a lot of money, that have strong currencies, a lot of purchasing power? So Canada, Australia, parts of Europe should still be very much part of their equation. But beyond that, of course, there's so much excitement in the emerging markets. And if I have one goal, it's to get people to think beyond China. Because I don't know what listeners think, but wherever I was going in the last couple of years, all I ever heard was China, China, China. And yes, China will one day perhaps be the world's largest economy. It's very powerful in many ways. But so India will be, and I want people to start thinking. Maybe this seminar will just help them start thinking about the potential of Brazil, Argentina and Chile even, Mexico, very much Indonesia and Vietnam, Thailand, and Turkey, which is a place of great potential. So I am trying to get people to widen their scope. Nigeria, Angola, and my final point there is, again, you can't ignore the U.S. or the other wealthy nations or China, but we do live in uncertain times. So as with investments, don't put all your eggs in one basket. Diversify. And there are tremendous growth opportunities all over the world.
Great. So let's move on now to this, talking about the diverging job market trends in the key industries.
Yes, this one I can cover quickly. What I did is I went back to the start of the century to January of 2001, and I said, let's take the key industries in the U.S., and however many jobs are in that industry, call it 100. So I made an index, and I just followed out the amount of jobs in these industries right until those numbers that were announced about a week ago, which showed job growth in general, but disappointing job growth. And I just have to make maybe 2 or 3 quick points. The first one is that brown line that goes up and up and up are jobs in education and health services. And what we see is every month there are more jobs in the U.S. in education and in health services than there were the month before. And that even holds true for the time of the Great Recession when we were losing so many jobs. So the takeaway here is even with some return of manufacturing, the U.S. is a service-based economy, and there are great opportunities, for instance, for the parents listening in health services. As the baby boom ages, there's more and more jobs being created in health services. Also, there's a wave of the echo boom, as we'll see, the kids of the baby boomers coming into college, coming into graduate school, and that's creating a lot of jobs for us in education. The only other 2 ones I want to call attention to are the blue line. That's the one that went way up and way down and now is really not bouncing back, and that's jobs in construction. And we see how the housing boom and bust really drove this past decade in many ways. The blue went way up, more and more jobs in construction, also commercial real estate, but mostly the housing boom. And then it went bust and dragged things down and really isn't coming back. And that is, along with the problems in the job market, the distressing thing, the continued weakness in housing. Finally, we see the terrible times that manufacturing jobs had. The red line at the bottom came down in that recession we had in 2001, stabilized, came down a lot in the Great Recession, stabilized. But if you have very good eyes, you will see that it is turning up every month in the last year or so. Still down 30% from what it was at the beginning of this century, but the turn upwards is a very positive sign for us. Now, on the next graph is a very positive sign for people who are working right now in international businesses or businesses that can become more global, because this shows, again, with a longer-term perspective, there's going to be a lot of growth out there. I calculated that for the next 20 years, world population is forecast, and this is by the UN, by the World Bank, the forecasts are all very similar. The world's going to add about 70 million people a year, about 1.4 billion people in the next 20 years, which is 100 more people every 45 seconds. About 200 babies are born every 45 seconds, and of course some people die, but a net gain of 100. But where are they? Well, over the next 20 years, we see that only 3% of world population growth will be in the advanced economies. And that's mostly going to be in the U.S., Canada, and Australia. Those are the ones that will be growing. Some will be declining. For instance, the declining populations of Japan and most European countries. So the opportunity will be out there once again in the emerging markets. So I don't want to beat that point to death, but we see that there will be more and more people in India, in China, in Latin America, in other parts of Asia besides China and India, Indonesia, Vietnam, Thailand, Philippines, and this means great opportunity. If it was just more people, then it wouldn't matter for business. But we saw before that in so many of these countries, people are gaining purchasing power. They now live in large economies that are achieving economic growth and that are forecast to keep growing. So this is a kind of an emerging, swelling lower middle class. And even if it's a lower middle class, they all of a sudden have some purchasing power for your products, and this will change the world. We see there's a lot of population growth in Africa, even taking account of items such as AIDS or HIV and wars. There's higher birth rates. And in many of these nations, as I said, the economies are doing well. All right, let's move forward with this more optimistic demographic picture that I'm giving to take a look at the structure of U.S. population. What this is called, and I'm going to show you a number, and I can then do them quickly once you get the idea. These are called population pyramids. At the top, we have older people. I used to call them old until I passed age 50. But for the U.S., for instance, we're counting how many millions of people 85 and above. At the bottom, young people. For instance, at the very bottom, the red is 0 to 4. On the right-hand side, how many millions of females. And you can tell that the right-hand side is the female side because if you look at the older people, there's many more people on the right-hand side, that yellow bar. And as we know, women live 5 or 6 years longer on average than men in the U.S. Well, the upshot of that is we see this bulge where I have the red X. That, of course, is the baby boom. We have a lot of people in the U.S. in their late 40s and their 50s and their young 60s. But I want to give 2 points that lead me to have a very optimistic vision of the future of the U.S., much more optimistic than most people. Some people say, well, the U.S. baby boom is turning 65. It's going to be all over for the U.S. Actually, if you see that light blue, the biggest part of the baby boom is late 40s and then early 50s. But also the green check shows the echo boom, the kids of the baby boomers. And there's so many of them from age 15 right through the 20s, and they'll be the ones who will be working eventually once we can take care of our unemployment problem and paying into Social Security and into Medicare when baby boomers, like many of us who are listening, want to retire. They'll give us a growing labor force. And we see that on the bottom graph. Even in 2030, the U.S. will have a bigger population, and that check is following the echo boom. There'll be prime-age workers more than ever, 20% more labor force in the U.S. paying into Social Security. So that makes me feel good. The next slide just summarizes that for you. I hope that can be useful as you talk to people in your firms and to your clients. We had the baby boom. It was 4 million a year for those 19 years I indicate, 76 million people. Then we had the baby bust. We didn't have too many kids because of Vietnam War, etc. So in 19 years, we only averaged 3.5 million babies a year. But now, for a much longer time period, so I've named it the extended echo. You won't find this anywhere else. It's an original idea I want to present to you in case it's useful. We've had now 27 years, much longer than the original baby boom, but with 4 million babies a year, as in the baby boom. So we have 108 million of these young people. And again, that's why I'm not as pessimistic about the U.S. as many people are. I think amongst, let me make a statement, amongst the advanced nations, the U.S. has the best demographics for business and for economic growth. The next graph summarizes that. This is Germany's picture now and in 2030, but it exemplifies the pictures all throughout Europe and also Japan and nations like that. What we saw is they also, after World War II, had a baby boom, so they have a lot of workers, so they're okay for now. A lot of workers in their late 40s and 50s, but they don't have that echo boom. They just stopped having babies, and they don't have as many talented immigrant workers we have coming in from places like India and China. So what we see here is that as we get out to 2030, these nations, Germany and the other European ones and Japan, will just be older nations. They'll be top-heavy with shrinking labor forces, shrinking populations. So again, the U.S. looks good. Australia and Canada have more of a picture like the U.S., emerging markets, not to ignore the Germanys and Japans. They have a lot of wealth. But again, the demographics start to favor emerging markets. China, we can see it's a much younger structure, meaning so many people on the lower parts of the graph, the younger parts, and there'll still be a younger structure or young enough in 2030. Most of their people will be that dark blue or below, 65 or below. As we get beyond 2030, because they had that one-child policy, China will start to have a bit of a shrinking labor force as its big population passes out of the labor force. And at that point, well, then what happens if China ultimately ages sometime after 2030? Well, then we see the beauty of India, but also if you look on the left-hand side, all throughout Latin America, Mexico, Brazil, Chile, Argentina, Colombia, we see a very similar shape. I'm showing you this shape for India because the numbers are so big. Look at it, 60 million girls just between age 0 and 4, but they all have this shape, and it's a beautiful shape because it has something of a fat middle. There'll be most of the people will be in the labor force, will be working, those middle ages, and not too many older people to have to support, so their financial structure will hold together. So I use this as one more advertisement for the future of an India, and by the way, Vietnam and Thailand, very much like this, Malaysia, and all throughout Latin America. Finally, and this can lead us toward questions, we need to think about U.S. debt and U.S. inflation. Then we can talk about that in the questions. Where I put the green check, that is 2011. If you look on the left-hand scale, which applies to the red bars, we now have $14.3 trillion of debt, and many of you know that because we've hit the debt ceiling and there's all that talk. Once we raise the debt ceiling, which we will, by 2015, we will have about $18 trillion of debt according to current forecasts. On the other hand, what is important is the debt compared to the national income that you can actually use to service the debt, the total production, GDP. That has gone up in a distressing way in recent years. On the right-hand scale, you can see we're approaching 100%. We will approach it. A debt as large as our total national income, and it was more like 1/3 back in 1980, and it's going to reach up to 100%. But according to the latest forecasts by the economists, which is not the government, it's not the government trying to push something over on us, it's the economist forecasting unit out of London, they actually think that the U.S. economy will get back on a growth path, that our income will grow, that now with the changes in Congress, for instance, we will eventually get a handle on our spending, our government spending, and we can actually reduce the government debt, not in dollar terms, as you can see with the red bars, but as a share of our GDP. Maybe we can get a handle on things. Well, we'll see that as the debates about the government deficit go on. But the main thing is to keep the economy growing. Just as an aside, notice the total government debt was $1 trillion in 1981, and now it's $14.3 trillion. Not a pretty picture. Okay, now what is a better picture is this one, which is inflation. It's actually not too slow. If we had deflation, if prices were going down, for instance, all the people in the U.S. with debt, such as mortgages, would find it very hard to pay their debt. A little bit of inflation is a good thing when there's a lot of debt, and we have a bit of inflation. But I do want people to see it's not 5 or 6%. It jumped up a little bit when gas prices were high. Last month was a little high because gas prices were still passing through. But as many of you know, now the gas prices are coming down rather rapidly, and oil prices. The forecast is that we're going to keep a lid on inflation. It could be at a very good level, somewhere around 3%. So I'm just going to conclude now and turn it over to you for your questions. I want to advertise my website. Over time, I'm going to try to keep graphs like this on it and update them. I don't sell anything on the website, so it's actually not an advertisement. It's just a chance for you to keep up with the graphs, for instance. Okay, I'm very interested to hear your questions.
Thanks so much, Jeff. If anybody does have a question, just remember to click on the question icon and type in your question and hit send, and we will get it into our queue. One person asked, as I'm looking at what you're talking about, I'm looking for opportunity. Aren't we going to see more and more countries move into the emerging category? And if you are trying to think about your own strategy, should you be trying to find those countries that are about to emerge and be really targeting them with your goods and services?
I think that's a brilliant question. It goes a little bit back to my China. I think so many people we know about China. By now we know about India. It's some countries I try to throw in there like Ghana and India, even Colombia are doing quite well. Vietnam definitely, although people are even discovering Vietnam rapidly. So I think that's a wonderful question that you don't want to be where everyone has already gone, because in so much competition it drives down margins. So do think about some of these African countries that are doing well. You have to look at their indexes of governance. For instance, on Transparency International, they have a corruption index that's free on their website, Transparency International. But some countries have really reduced their corruption. And again, think of some of the ones in Latin America that aren't as obvious. Colombia, as I said, Chile's doing quite well. Even Peru in some ways is doing better. So it's a wonderful question, and I think we've thrown a few out there, and I can slip others out over time for you.
Following up on that, someone else asked, can you talk about some of the opportunities that might exist in these markets? And they particularly ask about things like telecommunications and customer service.
Yes. One thing that's interesting is there's increasing talk and actual profits being made, but people can start by doing some research in a surge of private sector activity in telecommunications throughout Africa. We've obviously leapfrogged past landlines, so there's great opportunity there. And there's increasing purchasing power in Africa. People may wonder why I keep mentioning Africa. It's not a matter of, for instance, being politically correct. There are 1 billion people in Africa. We saw that 1/3 of world population growth is in Africa. But more importantly, many of the economies are growing more than 5% a year. There's tremendous natural resources being discovered throughout Africa, and that's bringing in a lot of investment. And people are reaching the purchasing power where they want to have phone service. So that's just one example on telecommunications. We're still seeing, of course, growth in India and in parts of Latin America. And again, this leapfrogging to later generations and to satellite technologies really gives great opportunity. In terms of service industries, I don't want to underestimate the tourism sector. Some of my own research shows as economies get richer, as people get richer, they want to do international travel. I'm sure a lot of people are listening. One reason they work so hard and their executives is they'd love to go to the Caribbean or spend some time in Australia or go to Europe. It's a natural thing, but as we make more money, we have the opportunity to do it. Well, as I go to, say, resorts in the U.S. to give speeches, I see more and more international families, and not just from the rich countries, but from these emerging markets I've been speaking about. So anyone in the U.S. that can think about a way to plug into things like the hospitality industry or various service industries, the U.S. makes huge amounts of money on international visitors, both business travelers and tourists, and that will only grow. But also as people all over the world gain purchasing power, whether you're a U.S. company thinking of investing in, or you are now listening, you're part of the 1/3 of people that are listening from countries in Southeast Asia, some in Latin America, some in Australia, which have tremendous potential to continue to develop their tourism industries. I want you to think about that. Also, people think about outsourcing, for instance, telephone services or computer services to India. That's overblown. Outsourcing is now taking place all over the world because there are some very low-cost workers who do have good educations in emerging markets throughout the world. So I want people to think of not just outsourcing to India, but for instance, there's a lot of outsourcing to Jamaica, which has a good educational system and low wages.
Jeff, I want to thank you for this very good discussion. You've given us a great picture. I think that's fair to say an optimistic picture of what opportunities exist for all of us out there in the global economy. I want to thank all of you for joining us today and thank UPS for making it possible. This concludes our presentation. Have a great day.